Hello and welcome to Moving Market Podcast. I'm JR Gondek, and as always, joined by David Sokolowski. David, super busy month of July. A lot of activity, a lot of potential changes going on with the economy, earnings season and such. So start with kind of some market commentary.
Yeah, Jared. So month of month of July had very strong performance. You saw the S&P was up over 2% with really just the trend of growth continuing to outperform. We saw, as you mentioned, earnings come out and in many cases better than expected. But the area where earnings were particularly strong and you saw companies have very solid results as a result of were tech. So you saw a lot of the big names continue to do very well. The continued investment in AI and the purchase of the various different chips that are required and the infrastructure that's there continues to be a very large part of the U.S. Economy. And then you saw mid-sized companies, also continue to do well. We've seen them more recently move kind of in tandem with large companies. And a big driver of that has been utilities again and tech. So you see a lot of the utility companies that provide energy to a lot of the tech companies do very well as tech itself. And then the one area that we've seen, struggles and continue to see struggles is in the small cap sector. And a part of that is driven by just the overall US economy. We'll jump into labor and some of the GDP details, later in the conversation. But you're seeing small cap continue to be squeezed. And part of that really comes from the higher interest rates that they're exposed to. Part of that comes from most of their demand being in the US. And so that continues to be one area of weakness. And then, as we talk about bonds and interest rates overall, there was a lot of volatility over the last several weeks as trade deals got announced, as economic data was released. And the expectation is that rates will move lower. And I think that's worth having a conversation about today as well.
And David, when you look at the economy, we got sort of the second quarter scorecard on GDP, which came in better than expected, close to 3%. On the other hand, we're down a 0.5% in the first quarter. So as you average out the first two quarters, roughly, you're at a 1.5% give or take rate. Looking in the third quarter, you kind of had a 2.5% expectation so far. Obviously, we're early into the third quarter, but the economy seems to be moving along. And as we've talked about, consumer confidence has been a big driver of that. And in general, as it talk about consumer confidence, two of the biggest factors are stock prices and oil and energy prices overall. And stock prices up, oil prices are down, so confidence continues to be a significant driver on trends within the market as well. And then late late last week you had the labor market statistics, right, and showed some weakness that has been underlying kind of the labor market probably the last few months. As you get some updates to some of the data, it showed some of the weakness that was probably in the ADP numbers, not the government statistics over the last few quarters. And that kind of leads you, to Fed policy, David. And then maybe there's some conversation and concern on people's mind. Are we in a bubble? Right? Are there parts of this that are overvalued? What's ahead? We talk about margin debt in a second that exceeded $1 trillion for the first time. So is that a sign of concern? So maybe let's take some of these charts and walk through them.
Sure. So I think, and maybe just to take a step back, we did have the Federal Reserve meeting in July. Rates were left unchanged. And just if you think about the timeline of some of these things, rates were left unchanged. You then had, weaker employment numbers. And you did have two Fed governors dissent, and they believe that rates should be lower today. And then a third governor who came out after the meeting and also indicated that rates should move lower because of economic activity, because of the weakness in the labor market and some of the more recent revisions that we've seen. So you've seen very significant revisions to prior months because of the way the data is collected, because of the number of people who respond to the surveys that come out. But regardless of what the reason is, you have seen those numbers move lower. And so the Fed is balancing their dual mandate of full employment and price stability. But the question is, where's more of their emphasis? Is it on the price stability, which means inflation, or is it on the full employment side? And that's starting to be a bigger part of the conversation. But looking ahead, based on what Fed governors have said, and just looking at the market outlook overall, you're seeing an expectation of, several rate cuts before the end of the year. So by December of this year, you're expecting to see, somewhere in the neighborhood of 2 to 3 rate cuts. And then the expectation is for more rate cuts next year. As you get to the end of the year, you're pricing in, 5 rate cuts, which translates to about 1.25%.
And David, to your point, that the Fed's continued to be in a tough position. Inflation trends have improved. They still remain concerned that tariffs that have been put in place, if consumer prices out next week, will that show a bump in inflation, or is it going to continue to moderate? And the data will see. On the other hand, to the point on the labor market is really flatlined, and their layoffs seem to have stopped through jobless claims and some of the weekly trends, but there just isn't a lot of labor market growth. And there was an article done on Gen Z, especially on the male side, demographic from 20 to 24. Unemployment's rising dramatically in that area. And it's just a lot of the recent college grads, harder to find jobs this time around. Part of it's probably the AI impact and other things. But again, it's definitely a concern on the Fed that they don't want the labor market to go negative, and you want to start to see more job creation ahead. So I think the easing of expectations of rates, at least 0.5% by the end of the year. And as you said, 5 cuts by September of next year. Now, what's the impact of this, David? When you look at our next chart is cash balances, over the last 20 plus years. And when you look where we are today, we're at record levels of money sitting in money market funds, well over 7 trillion as a recent data. So when you look at the impact of number one, there's still a lot of cash to potentially move in the market. But David, if money markets are give or take 4% today, if your money market rate 6 to 9 months from now is 1.25% or more or less, you're going to be in the twos. What are you likely to do with some of your cash balances?
Yeah, Jared, that's a good question. It's a question that a lot of savers are going to have to, and investors are going to have to struggle with over the coming, weeks and months ahead. But kind of like you pointed out, interest rates are higher today, and as they move much lower, if anyone has money market balances that are, around 4% now, they're going to be in the mid twos, let's say, or maybe in the high upper twos. So that really is not a very appealing interest rate, and it's going to force more activity and more risk into the market. Not to the same extent that we saw maybe during COVID when interest rates were zero, but certainly it's going to take some of this cash and try to allocate it to a couple different areas. One of those areas could be bonds, right? So instead of earning, let's say 2.5% on your money market or 2.75% on your money market, you might be able to earn 1% or 1.5% higher in the corporate bond space. And that'll be an area that becomes, more enticing to investors. The second place is value companies that have been really, neglected, I would say, in this period of time, and just high dividend paying stocks starting to have a little bit more interest because they, as dividend yields approach what interest rates are, you might take that risk and look for some upside on the stock side. And certainly a small portion, maybe not the majority of it, but definitely a small part will also be allocated to growth. So what you're going to see is a lot of this cash is going to make its way into the financial markets, whether that's through fixed income or high dividend paying stocks, with some component being allocated to growth as well. But again, the amount of cash reserves is encouraging just based on people's ability, the savings that are there and the ability to continue to spend and to propel the economy forward.
Well, the other area, David, too, that could benefit is housing, right? And depending where mortgage rates go, as I've said the last couple of years, we've more or less been in a depression as far as residential real estate activity. But as rates move lower and housing prices have moderated and fallen in recent months, that could be a catalyst to move some cash in and drive the housing market as well, depending on, if interest rates on mortgages move proportionally.
Yeah. And Jerry, you can see that, money market balances recently have been growing quite a bit. And that's a reflection of just the higher interest rate environment, right? So, people have opted to take maybe potentially a slightly lower return than bonds, but to have liquidity and access to their money if they want to use it for a particular purpose. But if you go back for the last, decade, basically from 2010 after the financial crisis through 2018, money market balances were much lower and were not increasing, right? So there was the push because of low interest rates, and it did force risk into the system. And that's what you're kind of seeing in this graph here is that they can be consistent for a long time, but at some point, investors are looking for the place with the best rate of return given the level of risk. And so as risk-free cash yields a lot less, there's a lot more demand for other instruments. But Jared, if you take a look, and we've talked about this, just the cash balances a long time ago. So in the first quarter of 2008 or at the end of 2007, cash balances were very high, the money on the sideline. But if you compare that to where the market was and the return that we've seen over that period of time, you can see it on the graph here. The cash balance, combine that with the blue line, which is the margin balance. So the cash balance that we just talked about is money market. It's cash that people have available. The blue bars that we see here are people's debt, margin associated with investment accounts. And what we found recently is there's a lot of different things to cover on this page, but more recently people have been using margin for different opportunities than they historically have. Historically, margin's been associated with investment. More recently, with higher interest rates and higher mortgage rates, margin's been used as a tool, as an alternative to home equity lines of credit. It's been used as an alternative to traditional mortgages. So some of that, some of those numbers are buried in here, despite the fact that margin balances look higher than they have. Even with the extra mortgages and potential home transactions that are built in here, where people are using that money for alternative financing, margin really hasn't grown at the same pace as the market or cash balances. And so what does that tell you, or kind of does that give you any concern, or do you feel like the market still has room to run?
Well, David, anytime you see these big numbers on margin, it's a sign is there too much speculation in the markets. Because again, when you look proportional, the graph's somewhat misleading with the S&P being the red chart, that it looks like they do definitely move in tandem, but you're missing the scale of the value increase, which is why we have the details. The S&P since the peak of 2007 is up 330%. Margin balance are up 100. So if you take roughly the percentage, in 2007, margin was roughly 4% of the S&P market cap, whereas today it's less than 2. So it's a concern, but there's so much more value. I mean, the S&P is up over 40 trillion in value, and margin balances are up roughly 600 billion. So it's a relative drop. On the other hand, looking ahead, when you go back to those rate cuts, that we talked about early, margin debt will go down proportionally for the most part. So that could induce more speculation in this number. I personally would expect, from a margin perspective, to only increase in the quarters and months ahead, especially if interest rates move lower. So to me, it's a good news, bad news scenario. There's probably still a lot of momentum left to the upside in many parts of the market. But are you building a problematic, market? Because like I said, as we started the conversation, is there a bubble? Maybe parts and individual companies that you could see some extra speculation and other things. But generally speaking, when you look at the broad, value and where things are, the cash still sitting in the sidelines, and you look at this earnings season overall, it was great, for the most part. So the valuation expectations were only better. So in general, I think you continue to see more momentum overall. And then the other big thing, David, bring it back to the Fed. When you look at tools and what else the Fed could do, I think the Fed balance sheet, which we haven't talked about in a number of months, I think is a good indicator. So if you look at the chart here, you see the big increase during COVID. Roughly 2 trillion. The Fed balance sheet prior to COVID was roughly 4 trillion. Then it went to 6, and at its peak in 2022, we're close to 9 trillion. Over the last 3 years now, the Fed has reduced, some of the cash in the system, and it's had much less impact, I think, on risk assets than all of us thought. So even as you look ahead, and if speculation, there's a lot of tools available to the Fed as they're cutting rates from 4.5% and have pulled 2.5 trillion. So it's going to be something to see. Will the Fed increase, this chart and start to bring, some of the money printing aspects, quantitative easing back in to maybe try to bring down intermediate and long-term rates potentially? These will be some of the things to watch ahead.
Yeah, John, I think, as we talked about interest rates and the potential for interest rates coming down, we are still in a period of relatively high mortgage rates based on recent past, right? Obviously, from a historical perspective, mortgage rates are not outrageous today. They're just higher than they have been more recently. But one of the things that we've seen, and one of the areas of the economy that is slow and remains challenging, is housing, right? Part of that is due to the housing affordability, driven by the price of a particular home. Part of that is driven by just the interest rates and where they are. So with additional improvements in interest rates, that's an area you could see, do a little bit better. And I think as as more banks are starting to point out these issues and as there's more reporting around it, I think, government officials may take a look and find ways to stimulate housing activity. There's been times in the past where there was a first-time home buyer credit. There was some proposals around using student loan debt as a down payment on a home, but all of those different things, or student loan debt forgiveness as a down payment for a home. So all those things could be benefits to the housing market, but even outside of that, you saw the reports from retailers that focus on housing and some of the home improvement companies, and those still continue to do pretty well. So there's, I think, some additional upside built in on that side of the investment landscape.
So as you kind of look ahead, I mean, to me, it's kind of the old saying, the trend will continue until it stops. So for now, I think as we look at the economy, we look at the majority of earnings reports and kind of the momentum within the markets, the trend looks to continue over the near term, and likely as we head to September around the first rate cut. On the other hand, as you pointed out earlier, David, as the market starts to anticipate and really price in these future rate cuts, it'll make some other alternatives within the markets more attractive and more appealing. And we've definitely been keeping our eye on some of the value stocks and dividends because they've been absolutely ignored, in the market over the last couple of years. On the other hand, you're seeing some attractive 4, 5, 6, 7% dividend stocks that don't have a lot of growth, but as interest rates fall, that could be an area to look for in the months ahead as there's profit taking within the market. And as you said, you have the two biggest companies in the S&P make up 15% now. So that concentration risk is justified in the short run because they've delivered results. On the other hand, we did expect to see some potential profit taking in some of this and rebalancing in the months ahead. With that, we want to thank you for tuning in. We'll touch base next month.
Thank you.